Hello and welcome to the Portfolio Manager. My guest today is Pranav Parikh, who is the Managing Partner and Head of Private Equity at Nuvama Asset Management. Pranav's funds manage roughly 7,000 crores, and he's here to talk about the sectors and key themes that are in play in the private markets and in the secondary markets. Pranav, thank you very much for joining us on NDTV Profit. My first question to you is that you have nearly 7,000 crores under asset and under management. What is the kind of themes that you work on in the private space, because you are an investor in the late stage companies?
Correct.
So where do you invest that money?
Great, thank you again. Firstly, thank you for taking me on the show. We, like you rightly said, we work on companies which are what we call IPO bound. So effectively we look at two things. We look at their IPO ability, their intention to go IPO, and ability to go IPO. So we'll typically invest in, like you rightly said, late stage companies. Now that can happen at listing, like a day before the listing, or it could happen 3 years before the listing, right? The intention and ability to go IPO is clear. Now so if you see why and what these companies are, typically these are companies that either a secondary sale needs to happen because a investor, I'll give another example. Recently in Sammy Hotels, or for example Fedfina, we did an IPO right before, we did a pre-IPO right before the IPO, because there was a need for the secondary solution to emerge, for some shareholders to sell into the sell before the IPO, right? Now we also do the last round before the IPO. It could be 1 or 2 years before the IPO, as a company looks forward to going towards IPO. We've done that in a company called Course 5. We've done it in the company called Ozone, which is effectively a fittings company. Just like you have an Heritage and Hafele, you have an Ozone, great growth story. So we've invested in that. It could be about 18 to 24 months. So the themes vary, but the companies are pretty much IPO bound.
I was looking at your portfolio, and a large portion of them are secondary market companies today, because they may have listed subsequently
since we invested.
So how do you look at the holding period for these companies, because many of them are multiples of the initial investments that you have invested. So what is the time duration for investing, and how long do you hold them?
So we have a very clear rule that we look at fundamentally a company for at least 3 to 4 years. Because when we invest, sometimes the clarity of IPO is not that clear. So when you come 2 years before IPO, while we call it 2 years to IPO, we don't know whether the IPO will happen in 2 years. What if a COVID hits? What if a Ukraine war happens? What if something untoward happens to the company or the industry? So it's never a given, right? So we have to take a fundamental view of at least 3 years. So even if I come a day before IPO, I have to assume that what if IPO doesn't happen? Right? Something can always happen, right? COVID suddenly hits, what do you do? What if the market suddenly shut off? So it all depends. But we typically take a 3-year view. So to answer to your question, it's a typical 3-year fundamental view. And even if we come a day before the IPO or 2 years to IPO, we'll typically to take a 3 to 4 year view. Post IPO, our exit is a function of multiple things. Typically, we want to work with the companies to identify the next set of investors who will sell into. Typically, institutional investor will sell into. But we will hold even post IPO 1 year, 2 years, 3 years. Because we are investing for growth, right? So ultimately, there's no magic, Sajid. So ultimately, if I invest, if the company's earnings don't grow, if the companies don't grow, I'm not going to make returns. Right? So we still typically look at 3 years.
So I was looking at your portfolio, Pranav. Most of the companies you have, doubled your investments, but give me a sense of the themes that you work on. Because if I look at your existing portfolio, where you have invested in the last 2 to 3 years, market and market intermediaries is the highest, because nearly a fourth of your investment is coming in there. Followed by, if I'm not, you have consumer discretionary, technology and lending, which is the next 2 or 3 sectors which is there. How is that theme now playing out? And where do you have you seen a shift in theme at your end?
Absolutely. See, if you look at, there are about 6,000 companies in the public market universe, and every year somewhere in that 50, 60, sometimes in a good year, more companies get added to the public market. But if you look at the private markets, right, there are hundreds of thousands of companies, right? Typically, by the time these private companies in the limelight of the public markets, there's a big kind of roster of companies that are ready and willing to go to the IPO markets, right? So our job is to identify a little earlier than what the market will ultimately accept. And to that end, what you find is in the earlier stages when we got into market intermediaries, we were a little ahead of the time, right? Then it becomes very public, and then now, the question of an NAC or a CAMS or a KFIN is a given, right? Given what's happening in the markets today. But when we identified them, it was a little earlier, way earlier than the markets identified. Same way, our job is to identify. If you look at the themes today that we're pursuing, the current themes that we're pursuing, we continue to believe that given the manufacturing focus of the government and the increase in the manufacturing footprint that this country is seeing, and especially this whole Make in India for India and for the world, I think it's a great theme that is playing out. So we are very focused on that. Now, that could be pure industrials, it could be new age manufacturing, electric vehicles, for example, being one of them. We identified a little early, we invested in Ola Electric. We, it's kind of on track to do IPO very quickly, earlier than what one would have expected. So we think thematics are consumer discretionary continues to be very interesting for us. I think premiumization is a trend that is playing out across the country, across various verticals, travel, tourism, so discretionary consumption where people are willing to spend beyond your normal, food and roti kapda makan, if you will, is where the themes are getting played out. So we are currently looking at a couple of companies in the consumer discretionary theme. If you look at an ozone, for example, I'll give you an ozone example that we have. It's a fittings company. So if you see the changes in the interiors that are happening, people are premiumizing even that. So even that, like an Heritage or a Hefle, when you are doing your home, right, you are premiumizing your content within the home, right? And that's benefiting everyone, the paint companies to these kind of fitting companies as well. So I think the thematic is premiumization, is urbanization, is consumer discretionary, it is manufacturing, it is specialized manufacturing.
Not the consumption as a whole basket, like a traditional consumption basket where you have from the bottom of the pyramid to middle, where actually people think that there's a huge demand or the entire base is there. You don't see that kind of growth coming in there at this point in time?
No, we do. I'm not saying that's not growth, but we have to identify companies that are yet not public. A lot of the basic consumption needs are really played by the large listed entities currently already, and that continues to grow. But when we have to identify companies that are yet not public and are playing that premiumization theme, which is faster growing. I'm not saying the consumption is not growing, but the premiumization is growing much faster than pure consumption as a basket overall.
How do you look at the financials? Because that used to be a big, sector where the private equity or the private capital was moving towards fintech, insurance, brokers, lending business. Have you seen a pause in there because of the kind of regulatory curbs that have come in, or the tightening by the Reserve Bank which has come in? Have you seen something of that, sir?
Yeah, I think, if the economy has to grow, I think the credit growth has to come. If the credit growth has to come across the board, whether it is corporates, MSMEs, and consumer, right? I think we can't grow as an economy unless the lending also goes alongside with it. What you find the regulatory angle to it is that the regulator is very focused on identifying pockets of exuberance and clamping down on that. So if you see the lending restrictions or the lending questions that are being raised are primarily around consumer lending, and that too unsecured, which is people are taking money and just putting into buying stuff, right, consuming stuff. But if you see MSME, it's still a large problem to solve, right? I think that continues to be a very large opportunity that a lot of people are going after. So I think credit, we continue to believe, is a large sector, will continue to attract private capital, and there is no choice about it, and we are quite excited about it, and we believe that across the board, I think you will find good companies that will emerge over the next 10 years, and we continue to identify some of them.
Okay. Give me a sense of how you look at technology as a as a whole, because that's I think the third most invested company sector for you. 16% of your portfolio is coming there. How do you see technology? Because in the last 1 year, we've seen a slowdown happening in technology.
Yeah.
So where do you see this hope coming in technology with respect to? Are there pockets where you see investments can come in?
Yeah, absolutely. So if you see, one of our investments is a company called Course 5, right? So technology is a very broad word, right? I mean, technology, you can talk about consumer internet, you can talk about, effectively companies like Course 5 Intelligence, which are effectively a data analytics, AI services type of businesses. You can talk about data centers. You can talk about technology-enabled businesses like platform companies such as Zomato, etc. You can talk about D2C. I mean, it all depends on technology as a word is a very broad word. So I think depending on the opportunity, depending on the specific subsection of the technology, I think there are opportunities. And especially in the context of our fund, where we're looking at...
Where have you identified?
Yeah, the companies has to also be IPO-able, right?
Yeah.
We are not an early stage fund, we are a late stage fund. So for us, scale, size and ability to go IPO is very important. And so, to that end, there are limitations for us. So we are very clear, Course 5, I keep on going back to, is absolutely an IPO-able company. So that's something, profitable IPO-able, high margin, high ROE business. I think you will find, I think the public markets have started to embrace. You see a Zomato being embraced, and it's not the market's embrace. If you think about it, it's actually the adoption of the market. As a customer, when you start adopting and becomes part of your life, effectively gets reflected in what market believes is the potential for the company, right? So it's not the market is accepting, it's just the market will realize that, some of these companies are here to stay, and here to stay for long as part of our lives on an ongoing basis. So I think if we can identify such pockets, then it's interesting for us.
Can you name some pockets within the technology space?
Yeah, so if you look at, you talked about, electric, for example, as a theme. We identified EV as a theme or electrification as a theme, not today, about 2.5 years ago.
Yeah.
And our job was to come in early enough to play that theme at that point in time. The best way to play that for us was Ola Electric. And that's what we ended up investing in, right? Course 5 as analytics, as this whole data proliferation everywhere, and enterprises accepting data and really driving data-driven decisions was an outcome that we did it through Course 5, for example, right? We constantly look at opportunities, but I think, if I, for example, look at 100 opportunities and probably do a lot more detailed work in 10 in other sectors, we probably look at 200 companies and probably do 10 deeper dives in this sector, because ability to take them to IPO, ability of them to scale, ability of them to sustain this going forward, even in the public markets, I think the probability goes down a little bit in these segments.
Pranav, we'll come back after a short break, and we'll discuss how to value these companies, because many of the companies which you're taking to public markets, there is a mismatch between the valuation that you give and the valuation which has been given by the public markets.
Sure.
So we'll discuss that after a short break. Stay tuned to Portfolio Manager. Welcome back. You're watching the Portfolio Manager, and with me is Pranav Parikh, who is the managing partner and head of private equity at Nuvama Asset Management. Pranav, we were talking about some of the companies, especially platform companies, where there is value and you're trying to invest in them, so that especially because they are in lease stage or they are IPO-able in the next 2 to 3 years. My first question to you is, how do you value platform companies? Because the biggest issue with the markets is that the moment it comes to public markets, the markets is not able to figure out how to do it. Even though some institutional investors invest, and we know how IPOs listing, they may list at a premium, or they may go into a discount, like a Zomato, which went down all the way to 45 and then it bounced back.
Yeah.
So how do you value a platform company?
Yeah. So I think the valuation of any company ultimately boils down to the fundamentally what is the way they make money. If you, let's just keep our discussion to the platform companies, right? What do these platform companies end up doing? Let's just take a Zomato, for example, right? Just as an example, right? Most of these platform companies will, charge a fee. Then the question is the fee enough for them to make a profit out of it? And if so, at what stage do they make profit out of it? So, for example, for every 100 rupees of something that you order, if you're making 20 rupees on it as a commission or as your take rate, if you will, just like an Amazon takes 5-7%, or a Flipkart takes a 5-7-10% depending on the category. Let's say a food delivery company will take a X percentage. Then the question is, what are the costs that get associated with that, and do they break even? Can you make money on every transaction? And if so, at what are the conditions under which you can make that money? And then how big do you have to become to cover all your fixed cost? Because if you're only doing like 2 or 3 transactions, so you'll never make money. But now if you start to assume that the adoption will be such that you will make thousands and thousands and lakhs and crores of transactions, then it's a fantastic business, right? So what happens is, when you invest, for us, we are forced to take a little long-term view, because unlike the public markets, where you have an ability to say aaj haan and tomorrow no, you can sell today and buy again tomorrow, or buy today and sell tomorrow. The private market investors don't have the same luxury, right? So for us, we have to take a 3 to 5, 4-year view. In fact, we have to say that when we are ready to exit, how will the world look at it from there on, right? So we typically take a long-term view, and for you to take any long-term view on any of these businesses, you have to understand whether they make money firstly on the unit economics, and if not today, how will they make money, and what will be the drivers to make them money? So let me explain. When you have a company that takes 20 rupees, typically you will look at, for example, a company like Zomato. I'm just using an example. Will have a direct cost of a delivery boy who comes and gives it to you. So there's a seedha cost there, right? If you look at a company which is, let's say, a ride-hailing company, for example, a ride-hailing company has no cost. So there is no variable cost. It's all fixed cost. So then the question is, as number of transactions keep on going up. So for example, Zomato 3 years ago, the number of orders they were doing per day versus what they are doing per day today is phenomenally different. Now everything beyond the variable cost flows down to the bottom line, right?
True.
And therefore, sometimes it's about waiting and letting that play out. Now the question is whether the customer will adopt, and will that adoption will keep on increasing. In certain cases, it's very visible because they become part of your lives, right? Ride hailing, eating out. Nowadays, everybody's saying quick commerce is so quickly becoming so valuable to you. So you took an example of Zomato. When it went down to 40, 45, and when there was a Blinkit acquisition, right? People were questioning that acquisition. And now, because there is a clear adoption and people are saying, oh, quick commerce can become more than just groceries, everybody is extrapolating it to say it can become really as big or bigger than Zomato. That gets valued. Now, the good thing about public markets is it corrects very quickly. Private market investors, unfortunately, don't have the luxury of this kind of volatility. So we are forced to take a 3 to 4 year view, sometimes, or longer term view. Sometimes you can be, sometimes, adoption is much faster than you anticipated. Sometimes it's a lot,
when does the
slower.
cash flow issue come into play? Because at the end of the day, if you're not generating cash, you can generate cash and you can be loss making.
Yes.
The market will forgive you. But if you're not generating cash and not making profit, the markets won't forgive you for that.
Yeah, absolutely. So what happens is, and in private markets, I think that's one of the key determinants for us. Because it's like, you're trying to go from one end of the lake to the other side of the lake. It doesn't work if you're going to drown in the middle. You have to get there. You have to get from, if the unit economics are working, then you have to get to the point where you are going to be really, really profitable. And that profitability can be enormous, right? Because it's a very high fixed cost business. At some scale, you just make a lot of money. So we do obviously look at it very, very carefully. What happens in the valuation side of things is, when you have interest rates like in 22, when they just shot up, any cash flow which is very long duration, agar aap 7 saal ke baad, if you're going to do cash flow, if you're going to start earning cash or going to do cash earnings, and then suddenly the interest rates shoot up, then the value of that cash flows goes down so much that the value gets deteriorated quite dramatically, right? So I think longer the time that you get to cash flow break even, the more volatile your pricing is going, your stock price or your value is going to be.
How do you compare a traditional platform which is there with a new age platform? Now, let's take an example of Ola Electric. You spoke about it, right? Now, it's a two-wheeler company. We have a comparison in the traditional with the Bajaj and the Hero coming in. How do you compare them, or should you compare them?
Yeah, well, I mean, I think at the very bones of it, at the end of the day, it's a two-wheeler, it's a automobile company, right? I think there are few differences, and I think, you know, if you look at the history of EV globally also, I think things have played out a little differently, and there are multiple reasons for it, right? One is your go-to-market, right? Your go-to-market in certain cases tend to be very different. I mean, Ola Electric's cases, you know, they are not your traditional, they're not doing that traditional dealer model. Now, there are economic benefits and, you know, pluses and minuses, but economically it's a better model if you can make that happen, right? This is also the Tesla model in the US. And then, you know, it is about growth. Ultimately, at the early stages of the company, the multiples that you get are a function of growth. So if you are a pure EV company and your growth is tremendous because you've got adoption, see, nothing happens if customers not going to adopt you. You can come up with an EV company and agar uska sale nahi ho raha hai, you're not going to get the value. But if you're going to get good adoption of those, you know, of your products, and your growth is staggering, then you will get a valuation multiple that could be better than what could be a, you know, a slow growth multiple, right?
So basically what you're saying is, in simple terms, look at the multiples of the revenue which is there for a platform. Don't go into EBITDA or PAT at this point of time.
No,
the growth
not really.
will be determined by the profit, the revenue growth which is happening.
I'm
right?
saying not necessarily. I'm saying in lot of cases when we go in, that profitability is already there.
Okay.
Right? In some cases, very visible. I'm saying in a lot of cases where it is not visible, people have to take a little long-term view. But if it is, a lot of these companies who are IPO bound are very, now at least, very cognizant that they need to either have profitability or show profitability in a very short period of time, or at least get there very quickly.
So how should a public market look at it?
I think, you know, again, it will still go down to growth. It will still go down to whether this company can gain market share, can become a large company, and what does it look like in 3-4 years from now, right? I think the multiple will and the valuation will depend on that. But ultimately, 3, 4, 5 years from now, it is still ultimately at the bottom line, it's still a EV company, or in this case, you know, it's a EV company. Now, can people see this becoming more than just a one product company? Because globally, there are not too many companies which have become just just a two-wheeler and four-wheeler combined. Is it local versus global play? Those type of things. So if you look at, you know, automobile companies are not just local companies. Globally, they are global companies. They're not just India companies.
Yeah.
So, you know, the question is, can a company, let's say in an EV business, become more than India? Is there a right for us to play and right for us to win as a country? Can we export? Can we become an export hub? Can you start producing for the global markets? I think all of these are factors that need to be taken account when you value the company. So it's not a straightforward thing, but yeah, ultimately it's a automobile company.
So, you know, many of the last stage companies or IPOable companies, they falter because they come on the public platform, and then the governance standards are not up to the mark, or they are not able to meet the kind of compliance and governance standard that is expected from them. In your experience, how have you tried to manage that? Because not every, you know, not everywhere investors have a professional, you know, management. It can be, you know, the founder which is there, and then and the founder is just listing so that he can give an exit to the private equity. So how do you manage that transition? Because many of the companies falter at that stage.
Yeah, no, it's a very interesting. I think it has become a lot more, you know, visible and a lot more in the know in the public markets, and I think that is now very well taken into account, right? I think over the last couple of years or 2.5, 3 years, I think there's a lot of maturity that has come in that system to know that not only if you are not ready, I think people, you just won't see companies going public. You just won't see, because there will be a lot of hurdles to go public if you're not ready from a governance, from all of those perspectives. From a founder leading the way, I think it's okay, right? Because, you know, we are so used to promoter-driven companies in this country. I mean, founder is no different than a promoter at the end of the day. Their economic stake may be much lower than you know, traditional founders, because they've used external capital early on in their life to grow much faster. Earlier, it used to take 20 years to get to a point where now external funded companies can get to it in less than a decade, right? And therefore, it's that speed, which is why their economic stake would be lower, but their, you know promoter-led companies, founder-led companies is not a bad thing, as long as the, like you rightly said, the foundational elements are put in place. But I think today I think there's a lot of skepticism at the investor level, at the board level, even at the founder level, at the bankers level, that are you ready to go IPO, right? And do you have all these systems in place? And I think that has changed dramatically in my view, at least at this stage.
Pranav, it was a pleasure talking to you today. Thank you very much for joining us on the Portfolio Manager.
Thank you so much for calling me.
Thank you.
Thank you.